Has this happened to you? You're sitting there waiting for the earnings of your favorite company and they come out with amazing earnings, but the stock falls anyway. Well, it sure has happened to me, and every time it happened back in the past, I would be sitting there wondering what the hell just happened. This counterintuitive occurrence can confuse new investors quite a lot during earnings season, as it used to happen to me. This became much easier to handle once I learned a few more concepts. In this video, let's explore why stocks sometimes fall even after posting positive earnings announcements. Let's begin. Before we begin, as usual, nothing in this video is financial advice and should be used for informational purposes only. This time or next time when your stock falls after posting good earnings, try to remember some of these concepts to ease the pain. And in this video, I'm going to use examples from the latest earnings season just to showcase some of the points. Anyway, let's start with the first reason, that is high market expectations. Now you might be wondering, of course the company needs to beat expectations for the stock to perform well, but that's not what we are talking about over here. This is a situation when investors expect companies to significantly beat analysts' expectations, not just beat the expectations. Often a pre-earnings rally prices in the expected good news, and now the market is expecting even more. This often ends up creating a buy the rumor sell the news scenario that can lead to profit taking even after positive results. The best example of this is the latest Microsoft earnings. The stock fell over 6% despite beating Q3 expectations. So basically what's happening in these scenarios is that everybody is expecting the company to do well. Now they want the company to do extremely well, and sometimes that just doesn't happen. This almost never means that the company did something bad. It basically means that the expectations were just too damn high. The next reason, which is quite closely related, is the future guidance concerns. So there's a company that performed really well this quarter, beat all expectation and is looking quite healthy, but they have downward revisions to future guidance that can spook investors quite a lot. You have to remember that markets are always forward looking and they focus more on future outlook than past performance. A really good recent example is that of AMD. It dropped over 10% after Q3 earnings despite 18% revenue growth, mostly due to concerns around future AI chip supply constraints. This is why it's so important to listen to the earnings call. The initial market reaction right after the earnings come out may not be right. You have to wait to hear the earnings call. During the earnings call, if they come out with some conservative guidelines, it can trigger a selling. Another reason why a stock might be selling off after great earnings is something known as whisper numbers. These are basically unofficial earnings expectations among investors. This is often higher than published analyst estimates and can trigger a sell-off as well. You might have sometimes seen or read this, that analysts are expecting the company to beat the estimates by 10 or 15%, and if that doesn't happen, they could see a sell-off. This is just a little different from the first point that we had discussed, because in this case, people are already discussing what numbers they really want to see even if they haven't put that out. And simply put, it creates a hidden expectations gap. A great example of this is what happened to Meta this time. It declined over 4% despite strong earnings, possibly due to higher unofficial expectations. I want to say that Meta is doing incredibly well and the consensus has been extremely positive too. But at the same time, it's a very well understood business and people are expecting a lot more from the company, and often this can lead to whisper numbers. The stock had dropped quite significantly 2 years ago because Mark Zuckerberg kept harping on about the metaverse. Talking about the CEO leads us to the next topic, and that is management issues could be causing the stock to fall. Apart from the financial health and the numbers, management is a key component of a good investment thesis. If there are leadership changes or controversies, this can overshadow good results in a big way. Loss of key executives can create uncertainty in the short term. There could also be governance concerns that can trigger selling, and even accounting issues can be particularly concerning. The best example of this is what's happening to SMCI right now. The stock has fallen so much because of management concerns. So in this case, the earnings have actually not come out, but they have delayed filing their 10K, which is causing significant concerns. This may also cause the earnings to be delayed. Now at this point, when the earnings do come out, it's going to be quite interesting to see what happens next. It can go either way. This is a situation that could have also occurred after they posted earnings, and those could have been good earnings, but if something like this happened, the stock would have sold off. This is something that you must pay attention to with respect to other companies as well. Whenever they announce something like the CTO or the CFO is leaving, you might see a bump on the road. Usually for good companies, that's not a big concern. Sometimes people just leave. However, it can be bad news if something significantly has changed. It can also be good news in the long run. And remember, just because the market is reacting negatively to something doesn't mean you have to. You have to really assess it for yourself and figure out what you want to do. You should never feel the pressure to sell the stock just because you see others selling it. However, talking about pressure brings us to the next point, that is sector-wide pressures could be causing the stock to fall. Sometimes there are just industry specific challenges that can override company performance. This could be competitive pressures that may cause concern for investors. This could also be broader market sentiment that affects individual stocks. It could also be economic factors that impact entire sectors. A good example of this is Apple, that is declining today after earnings, pretty good earnings that too, just because of weakness in China. Now this is very sector specific or because what's happening in the phone industry in China. You have to also understand that sometimes these pressures are cyclical and you should not worry about it all the time. You need to pay attention to if the company is able to weather these storms. If you're investing in good companies for the long run, you should not be worrying about these things earnings to earning. You should be looking at it from a broader picture. You should keep a general tab on the sector and don't take decisions abruptly. Try to understand what's going on over a period of time and then decide what you want to do. But often these sector pressures can actually lead to the next point we are going to discuss, and that is valuation concerns. Sometimes going into earnings, high price to earnings ratios can make stocks quite vulnerable, and profit taking after extended rallies is quite expected. The example of Microsoft can be used again over here. The stock has run quite significantly over the last 2 years, and it taking a breather is not the worst thing that can happen right now. A lot of people are now seeing Microsoft as fully valued, so you might see some volatility now. It does not mean the stock can't go up, but it also doesn't mean that people are not going to take profits and move into other stocks. Do you need to do that? Well, that's for you to decide. But if you're a long-term investor, you should not be concerned too much with these rotations. You should hold on to your investments for a much longer period of time. Microsoft has a great future ahead of it. So those were some of the main reasons why stocks sell off after good earnings. However, there could be many other technical reasons that we can look at. For example, there's trading patterns and momentum that can influence stock price movement. There's also large institutional selling that can trigger cascading effects. There's also volume patterns that may signal distribution. There's also short-term traders taking profits. There are also these other technical factors that could come into play. For example, you could see a chart and see that the stock is running into resistance. It's not uncommon for a stock to get rejected for a bit in the short term, and it might coincide with the earnings season. So I mentioned these because they are legit reasons. A stock can be selling off because of these reasons with or without earnings. However, they can coincide. But as a long-term investor, you should not concern yourself too much with these. If you're a long-term investor, stay the course and stop worrying about these short-term market movements. In fact, if your stock sells off after posting good earnings, it might be creating a buying opportunity for you. And this is why it's important to understand why the stock is selling off, because you need to quickly see if that's a real concern or is it something you should be jumping on. Remember, in the words of the great Benjamin Graham, in the short term, the market is a voting machine, but in the long run, it is a weighing machine. So keep the long-term view intact. On that note, I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.